Yeah, my current role is Executive Vice President, Head of Secondary Marketing and Capital Markets for the Mortgage Division. Um, so I really oversee everything from soup to nuts, or if you want to say bookends. So from creation of products to the pricing of those products, to the hedging of the rate locks, to the execution of the final closed loans through either selling to Fannie, Freddie, or Ginnie, whole loan buyers, or private label securitization, and kind of everything in between there. So quite a vast, array of different smaller businesses within secondary and capital markets underneath me. And so with that, I get a lot of challenges every day from different areas. The one thing that I've always loved about mortgage banking is every day is different. You wake up, it's not like I'm going to the same job every day. Every day is completely different, and there's always challenges. Sure, we've seen a rapid rise in rates, since January 1st. The fastest increase to mortgage rates that we've seen really since the Reagan administration. We're going back 40 years, 81, 82 range, somewhere in there. So we shot up, within 30, 45 days, over 100 basis points in a 30-year fixed, right? So we went from kind of this multi-year 3% kind of handle for a 30-year mortgage to 5.5 now today, actually. So, there's folks that we've never, have never seen 6% or higher posted on a rate sheet before, which we have that today. I think our rate sheets are going to around 6.5. So it's just been a huge reset, which we all knew was coming, but at the pace and the velocity which it's happening hasn't really been seen in, this century and a generation of mortgage bankers, really. So trying to deal with that has brought a lot of challenges, and trying to hedge in that market when the volatility is through the roof has proven to be a real challenge. And we've survived it, but it's day to day, hour to hour, making sure we're watching the market, watching our pipelines, watching the locks, that kind of thing. So that's been a really, really tough go there the last 90 days, for not just for Flagstar, but for a lot of folks. Yeah, I think we're going to continue to see volatility. I think it's going to last a while here. I think it's going to be another 12 months or so, maybe 18, before we really kind of get through this and shake it off and move on to the next round of whatever that's going to be. But we're also going to be coming into an election year too, right? So a lot of uncertainty around just the markets in general. How long is it going to take to recover from this pandemic, on top of the housing shortage? And then you've got a war going on and the presidential election. I think 23 and 24 we could see some more volatility. I think, where do rates settle? It's a tough call. The Fed has come out and say, no 75 basis point increases. We're going to do 50s. That kind of helped us a little bit stabilize for a day. But we're still seeing a lot of whipsaw back and forth on mortgage-backed securities, up one day, down the next, and vice versa. So I think it's just prudent to make sure that we're locking loans, not throwing the borrowers into an issue of either we have to provide a concession or talk to the borrower about, hey, sorry, this rate's not here anymore. Because the market can move, and it can move quick. I think the biggest myth really is a lot of us that lived through the great financial crisis, right? We still see ghosts of the past. So a lot of folks still think, oh, that's, your what do we call them? No income, no asset loans, or option arms that really hurt borrowers on reset. All that stuff's kind of gone, right? So you're qualifying borrowers. The ability to repay is a real thing, right? So ATR testing is there. Some of these programs require some decent down payments, so there's skin in the game. And I think the appraisal process has improved greatly since then in the last 14 years. So I think it's a combination of all of that, as well as for our partners that have referral partners like builders or realtors, you don't want to blow that relationship up, right? And you don't want to try to help a borrower and say, hey, I can get them into this non-QM loan, just to find out that it's going to take 60 days to try to get through these docs, just because your borrower's specific situation might be a little tricky to underwrite. I think it's a lot better now these days than it used to be, and the underwriting teams are highly trained in all of these products and can efficiently and effectively get them through the system fairly quickly. So I think it's don't be afraid of the products, and we don't want you to blow up a relationship with a realtor or builder either, right? And we want the opposite. We want them to come back and say, thank you for saving, Mr. and Mrs. Smith's deal. I can't believe you got that done. And I'm going to give you my next 3 referrals to you for, helping me through that. And it was a big deal. So this business still is high touch, in my opinion, especially on the purchase side. Folks want to have, be able to sit down and look at another human and talk about it. It's a very emotional process. So I think non-QM gives some folks a little bit of the jitters of, I don't want to mess up a deal. I'd rather not do a deal than mess it up. And I think that's kind of a fear that a lot of folks are going to have to overcome. We're seeing such a quick rise in rates here that we're from a consumer standpoint, your borrower behavior, I think folks are getting scared, right? So if you look at a $3,500 mortgage payment on December 31st, that could have given you the purchasing power of around $805,000. Today, that gives you the purchasing power of, say, about $640,000. So within a matter of 4.5 months here, they've lost that power of, call it $150,000+ in the price of the home that they were going to purchase. So I think it's been frustrating for a couple of facts that the borrower is having trouble even locating a house to buy because of the inventory crunch. But they're also seeing that while they're looking, their diminishing power to buy a house keeps dropping and dropping and dropping. So that's, I think, kind of taking some of the people out of the market a little bit right now that are like, hey, you know what, I'm going to maybe take a pause, sit on the sideline, let this thing cool off a little bit. And then on the other flip side of that, it's getting people off the fence. Like the people that have been waiting, like, oh my God, I gotta get out there and find a home because rates are only going to continue to go up, which history would tell us everything goes up, goes down, and everywhere in between, right? We have peaks and troughs. From our partner standpoint, I think it's, if I were running a small mortgage shop or a medium shop, I would be very focused on pipeline management. I would lock loans on application. I wouldn't mess around with trying to ride the market out. I would get them locked in, and then if things do change, work with my borrower or my partner like Flagstar to see what I can do to renegotiate or float down that rate. But I would take that risk off the table immediately. Yeah, I think you'll see us do more of the same of what we've done, just at probably a faster pace maybe, and a more grand scale. So when Fannie and Freddie stopped buying investment properties, we were in there, we pivoted immediately. We were the first to market with 2 deals in the private label market, 30-year fixed deals, before anybody issued one. We also issued the first 15-year deal that year. No one ever did that besides us. We came in third for the year in issuance on private label. So I think more of that will, more creativity and the ability to hold on to these loans and securitize later. Because at this point, we're not really a forced seller right now, but at 90 billion, I'm not going to be a forced seller. So I'll be able to sit on the loans for a little longer, either put them in portfolio or aggregate for a deal, whatever the best deal is. And when we could do stuff like that, that really helps our partners because I can put pricing power back into the rate sheet. So if I can achieve a greater execution on the back end, and I know that I can create a bond that will do that for me, I'll start pricing that in immediately so that we can get those loans in-house and help our partners. This is the time in the cycle when you learn about other products, right? I think everybody's been so busy the last 2 years with the deluge of volume coming in that was very vanilla, very government, FHA, VA, conventional loans. they didn't have time to really dig in and understand all the other different various products that can help folks get into homes or refinance homes. So I think now is the time to kind of take a deeper dive into the product guide and say, what else is out there that I should be selling, or I can make myself an expert in, say non-QM or HELOCs or whatever the loans are, product type that would fit your geographic location, right? And that's a huge thing. I think it's know your partner and know what they have to offer, because we have a huge suite of products available, and not all of them get accessed all the time. But I think there's a lot in there that could be used to help grow a business and backfill in for that, the volume that was achieved in 20 and 21, and help that bottom line. Get to know the product set. Don't be afraid of non-QM. It's really not that bad. I mean, it's out there for a reason. So we'll be launching more products here shortly that will help our partners. I think there's going to be a couple of them that should make a pretty big splash and really help out a lot. And, I think we're going to continue to see a little bit of the pricing irrational guys out there that, for whatever reason, their rate sheets seem too good to be true. And I think we all know that, right? It usually is. So we still have a lot of capacity in the market that hasn't come out. We've started to see layoffs, and there are some M&A activity here and there that are happening, but we'll need more of that to come out, right?